Hey, everybody. How are you doing today? Dan Grote, Scott Cody here with Latitude Financial Group, here to talk about long-term care insurance. I think the big question that we want to answer today is what is long-term care insurance and when should people start to think about it? Anything to add to that agenda, Scott?
Hey Dan, no, I think that's a great topic. It's always fairly timely, and that people have a lot of I think questions or concerns because I think it really hits home this topic because we've probably all had a neighbor or a loved one, maybe parents or an aunt or uncle that have been faced with, you know, aging and long-term care concerns.
Yeah, absolutely. When I think about long-term care, I think about usually I think about end of life kinds of things. But just definitionally, we're talking about the inability to perform certain activities of daily living, whether that be feeding yourself, whether that be getting up and moving from a bed to a chair, or bathing yourself, those kinds of things, and needing assistance for that. And the reality is today in our country, uh, getting help for those kinds of needs is extraordinarily expensive. And by that, let me put some numbers out there. Every year, Genworth Financial does a national study of the average costs of long-term care in our country. The 2021 national average range for different levels of care goes between $4,957 per month up to $9,034 per month, depending on the level of care that's needed. So it's not hard to see that those expenses are exorbitant. And it's why Scott and I, when we are preparing a financial plan for our clients who are uh, retirement ready, that this is one of the primary concerns that we want to address is how are we going to handle the potential need for long-term care. And just on that note, when I say potential need for long-term care, we're talking about roughly 50% of adults age 65 or older will need some form of long-term care at some point in their remaining years. Um, of course, there are variables, and some may need it for longer, some may not need it at all. But when you're talking about a probability of 50%, a likelihood of 50%, that's not insignificant. And with those costs, again, ranging between, I'm just going to call it 5,000 a month and 9,000 a month, it's not hard to compute how that could deplete your portfolio rapidly. So that's why we're talking about the subject. Fair enough, Scott?
Yeah, I think you're right on.
Okay, great. Scott, why don't you start us off here? The first I think angle we want to take on this is talking about just traditional long-term care insurance policies. Give our audience just a little bit of backdrop on what we're talking about when we talk about traditional long-term care insurance policies.
Yeah, in terms of, from a historical perspective, they've really are one of the newer types of insurance. They've really only been around since, call it uh 80s, 90s timeframe. And in terms of what they look to cover, depending on what generation of policy you had anywhere from policies that were facility only, meaning you needed to, uh, in order for the policy to trigger benefits, you needed to be in a long-term care facility. Um, so they didn't necessarily include always care at home if someone was receiving some sort of care at home for those activities of daily living. Now that has changed over time, I will tell you. Often today, the policies are much more comprehensive than they were in those earlier days. And sometimes they didn't include, things like adult daycare. Um, and again, as policies have become evolved and become more comprehensive, often those type of nuances have been covered, and again, they're more comprehensive. But with that, they're also, more expensive. Um, and we've seen those type of traditional long-term care policies, similar to, let's say, a health insurance policy or a disability type policy, um, evolve and increase over time because people wanted more of the bells and whistles and nuances included in them. So the expanse or breadth of type of care um, to be included. And so with that came increased costs.
Yeah, and I think there's a lot of distinguishing points about traditional long-term care policies and some of the other ways of covering your bases on this risk. But one of the big areas that's a point of contention with traditional long-term care deals with the premiums and the history of those premiums with these traditional policies for there being premium increases. There was a time with traditional long-term care insurance policies that the premiums were level, and that was something that the insurance industry prided itself on, was never having increased premiums on an existing block of business, on an existing customer base. But those days are long gone at this point. And what we've experienced, Scott, I know you've experienced this, I've experienced it, is uh, having customers that we've worked with who have purchased these insurance plans um, with the understanding of what their premiums would be when they took the policy out,
Mhm.
having received that unfortunate surprise in the mail that their premiums were going to be escalated, that their premiums were going to be increased, and in some cases, it wasn't an insignificant increase. It wasn't uncommon. I've seen situations where a client experienced a 50%, 50% or more premium increase. Scott, yeah, same experience for you?
Yeah, same experience, Dan. And it's not any one particular carrier. We saw it, you know, I'll call it generationally across, most, if not all, the carriers during a certain time frame. And that was based on the claims that they were experiencing, the insurance companies. And the claims
Yeah,
were such that, people were triggering benefits at a greater percentage um, than anticipated. And so, in hindsight, which is always easier to do, to play armchair quarterback, in almost anything we look at, um, the policies were underpriced relative to the cost of care and relative to the use or triggering the benefits of the policy.
that's right. That's right. And I think that's just it's just one angle on this, and these traditional long-term care policies continue to be sold today, and if they're properly presented, they can be maybe one of the most effective tools for planning for this risk that lays out in front of, again, roughly half of us. But it needs to be something that you're aware of. If you buy a traditional long-term care insurance policy, it's something that you should ask your agent. If you're working with an agent, what guarantees, if any, exist around the premiums that I will be paying for my policy.
Yep.
Great. Well, I think that's probably a great segue into talking a little bit about the hybrid um, policies that are widely available today, and that was really kind of a genesis of this evolution as far as how to address the risk of long-term care, where the life insurance industry stepped in and uh, addressed that concern surrounding the potential for an ever increasing premium by coming up with, I think, innovative products that are built upon a life insurance chassis that have guarantees surrounding premiums. So the premiums that you pay, albeit in most cases, that I've found, are higher premiums than what you would expect on a traditional long-term care policy. They are guaranteed in most of the cases that I've seen, the products that I've looked at. Scott, what would how would you elaborate on the hybrid life insurance, long-term care insurance policies that are widely available today?
Yeah, I mean, I think, what you're doing is you're kind of buying a multifunctional tool, if you will,
Yeah,
with an emphasis on long-term care, but also because we often get asked by clients, particularly when we're talking about the traditional types of long-term care. So if you think of other forms of traditional insurance, disability insurance, auto insurance, and life insurance is, what happens if I don't trigger a benefit or if I don't use it, simply put. Um, and with the traditional long-term care insurance, if you don't use it, you know, often you don't, you've paid in premiums and there's no benefit paid out, and you know, the money's essentially vanished.
use it or
Uh,
lose it, right?
yeah, use it or lose it, exactly. And so, and we could get into certain nuances for additional cost you can put on features, like return of premium. But that being said, if you don't have that, you use it or lose it, correct?
With traditional long-term care.
With traditional long-term care. Now, with hybrid uh, long-term care insurance, where it sits on a life insurance chassis, as I was saying, think of it as a multifunctional tool or multifunctional outcome. Um, if you don't use the long-term care and you or your loved one has, passed away and never triggered a long-term care benefit, there is a life insurance benefit or component that would pay out. So the dollars aren't gone. You, as a living member of their estate, would receive the money back in some format, in the format of life insurance. If they do use it and trigger a long-term care benefit, it's a pool of benefits of long-term care that you'll dip into as you use it. And based on um, the policy and how it's designed, is will tell you at what rate you're going to use it. So typically on a monthly basis, that's often defined, and for how many months you have the coverage and what that pool looks like
Yeah,
of benefit you're purchasing.
great.
And if you
That's
don't
great.
use that entire pool, then the remaining balance would be paid out to your estate as life insurance.
So we've set up some differentiators between traditional long-term care insurance and the hybrid policies. One being that the traditional policies reserve the right to raise premiums, whereas the hybrid policies are generally guaranteed premiums.
Yep.
And then the next difference is that the traditional long-term care policies generally are written in such a way that it's a use it or lose it plan. There can be exceptions and different riders and add-ons that you can add. They're oftentimes fairly costly, but they could be added that would make that not the case. But in general, it's a use it or lose it situation with traditional long-term care. The hybrid plans are, as you said, a multi-function tool that if you use it for long-term care insurance, you have a pool of money that you can use for that purpose. But if
Mhm.
lo and behold, you're one of the exceptions that do not need long-term care in your lifetime and ultimately you pass away without ever having used that benefit, the policy would have a death benefit there. And that death benefit could be expected to exceed the premiums you put into it by some measure. It may not be a huge leverage tool, but you're at least getting back out of it what was put into it with maybe some additional leverage on that money. So
Correct.
that's great. Let's from there transition to I think the third tool, um, which is the use of annuities for long-term care purposes.
Mhm.
Scott, my experience with this is that annuities are generally kind of the third line of approach to this challenge. And there's a reason, and that is that annuities generally are not offering the same kind of leverage on your money for long-term care purposes as would a traditional long-term care policy or one of these hybrid policies. They do, I think, have a couple of the benefits that we talked about when we talk about premiums. Well, the annuity alternative is one that you you can control what you put into the annuity. That
Mhm.
it's not going to come back later down the road and require additional input of new monies, new premiums into that annuity contract.
Yep.
Um, and there's also, I think, the benefit with the annuity that it's not a use it or lose it solution.
Mhm.
In other words, if you place a sum of money into an annuity for the purpose of that protecting you against the risk of long-term care expenses in your future, if you lo and behold are one of those exceptions that don't need long-term care in your lifetime, the annuity has a value to it that could be passed along to the named beneficiaries of the annuity. Um, but if you do need long-term care insurance, I think that's where the challenge is with annuities. Is if you put in a set premium into that annuity, let's say you put 150,000, 200,000, 300,000 into that annuity, you may experience growth on that money over the years between when you make that premium deposit and when you need long-term care. But when you do, in fact, need long-term care, what you get back out of the annuity may not be a whole lot more than what you put into it. Am I saying that in a way that makes sense, Scott? Is there a different way to explain that, you think?
Yeah, no, I think, you're explaining that. I think additionally, what I would add to that is in terms of qualifying for long-term care benefits, it's probably the easiest of the three that we're talking about today. So in terms of, getting a long-term care insurance policy or long-term care insurance benefits, in terms of health qualifying, it's probably the easiest of the three. But as you mentioned, because of that, you probably don't get as much of the bells and whistles and leverage for long-term care as you do the other two that we've mentioned.
Very good. And that's a new differentiator we just threw into the conversation, but a really good one is, why does a person choose one of these plans over another? And sometimes it does come down to the qualification and what a person's medical history is. One thing that I've found, or a question that I get is around surrounding qualifying various health conditions. And, that may be a history of cancer or, various other conditions. And I think the average, consumer thinks about this in under the construct of life insurance. Understand, though, when you're going through the application process for long-term care insurance, and maybe to be precise, when I'm talking about long-term care, I'm talking about traditional long-term care insurance plans. Some of those underwriting decisions may differ from what you think or what you would expect. In other words, the underwriter who's reviewing your application for traditional long-term care insurance is generally more concerned with morbidity issues, things that will prevent you from being able to care for yourself in the future. So if you've had, for instance, neck or spinal cord injuries, back injuries, or the types of injuries that might be likely to disable you at some point in the future, those are
Mhm.
going to be of higher concern to that underwriter than mortality issues would be, things
Yeah,
that will maybe someday kill you. Um,
right. So
so
maybe autoimmune or diabetes, because in most cases, like diabetes doesn't outright kill you, but it complicates other major issues that you may have, health issues, you
that's
know?
right. That's right. But just to summarize, the annuity alternative to addressing this risk, oftentimes annuities are the plan C of the financial planning process, and that
Mhm.
comes about oftentimes because it's a qualifying issue because of some medical history that a person has experienced. So great. Well, Scott, then I think from there, let's just touch briefly on some of the ways or some of the tax advantages that a person can use to pay for those first two policies for the traditional long-term care or potentially even the hybrid plan. And where I wanted to focus this conversation was on health savings accounts. Um,
Mhm.
and without getting into a long diatribe on the merits of health savings accounts, I'll just touch on that briefly, that health savings accounts are coupled with a high deductible health insurance plan that are quite popular in our country today as a way to control health insurance premiums. But the health savings account is a separate account that one can put money into on a pre-tax basis, and that money grows on a tax deferred basis. It can be growing at a rate of between what you would expect to receive on a savings account, and even in some cases you can invest funds in a health savings account in mutual funds like you would an IRA account, for instance. And then ultimately, when that money is pulled out for qualified medical expenses, it comes out tax free on the back end. And so health savings accounts can be a great tool for the purpose of paying for traditional um, long-term care insurance or even some of these hybrid life insurance policies. Now, I'll say with that, the hybrid life insurance policies that were first written were not written in a way that made them qualify as tax qualified for the purpose of health savings accounts, health savings account withdrawals. However, insurance companies, life insurance companies, have in more recent years began designing their policies in order to qualify as tax qualified and in for the purpose of tax qualified or tax free withdrawals from health savings accounts. So, Scott, what would you add to that conversation about using health savings accounts for this purpose?
Yeah, I mean, you know, you get a deduction on your contribution to the health savings, and then potentially being able to write a check to the long-term care insurance for a traditional policy um, works out pretty well. Um, and so, it has that potential to work really well from, a tax planning standpoint.
It's the old triple play, right?
Oh, yeah.
How
Yeah.
often in baseball do you get to see a triple play?
That's a
Uh,
good way to put, yeah, Dan. Yep.
I don't know that I've ever seen a triple play, but getting that tax benefit on the front end,
Yep.
along the way, and then also on the back end is powerful. So definitely something that our audience should keep in mind. Um, I think the last area that we should talk about is when to start thinking about this. Um, when to start addressing long-term care from a financial planning perspective. And um, my take on this may differ from yours, Scott, but um, I think that in a perfect world, it would be something that would be addressed before retirement begins and not be an added drain on one's portfolio during their retirement years. Now, I understand that that might be only possible for a select group of people, but I like to start looking where if I have a dual income household, perhaps, or a higher than average income household, I like to start looking at the possibility of this perhaps as early as their mid 40s, to where we could design a hybrid life insurance long-term care solution, that multi-tool that you described earlier.
Mhm.
Such a good description, by the way. Um, in such a fashion that it would be paid for over a period of time, perhaps 10 years, 15 years, or 20 years, such that if
Mhm.
a person started paying into one of these plans in their mid 40s, they could be finished by their mid 60s and have a plan of insurance that's paid up and paid for by the time that they are ready to actually retire. I understand that every situation is unique, and the ability, the wherewithal to do that when you're in your mid 40s may not be there, depending on how many competing goals you have, whether it's accumulating money for a second property, saving for one, two, three, four children to go to school, saving
Mhm.
for your own retirement. There can be any number of different competing goals that may present challenges to that, but
Yep.
that's a point at which I think at least beginning to think about it makes sense for some individuals and families.
Yeah, Dan, I just to add to that, since I think you put it really well, is competing goals. I think it's really important to prioritize those competing goals because often that is the case for folks. And, you know, this is where I think that multi-tool, multi-goal tool, like a hybrid life insurance or an annuity, can help with those competing goals. Often you can, take maybe it was a policy, a life insurance policy you bought in your 20s or 30s, and it's a permanent or cash value. And I know that's such a taboo approach in our world with certain financial personalities or influencers, if you will. Um, but I think that's where it also fits really well is if you have an existing life insurance policy um, that's a cash value or permanent form, you know, I would fire back to those influencers that are, just pro term life insurance only and talk about this competing goal and that the fact that you can, 1035 exchange, and that's a tax-free exchange from a like policy to a like policy and potentially get long-term care um, through a hybrid life insurance or a hybrid annuity and see really the benefits of having started a long-term a life insurance policy maybe in your 20s or 30s, and now you've got a bunch of equity or cash value buildup in it that you can, now you're in your 40s or 50s, or let's say even uh, early 60s, that you can move over to one of these, hybrid long-term care policies, whether that's a hybrid life insurance or hybrid annuity. This is where a great payoff of that is, having started it in your 20s or 30s.
That is such a good point, Scott. I've seen actual cases of clients who had that exact set of circumstances, that they had paid into maybe a variable life policy or an index universal life policy, since maybe even their late 20s, uh,
Yeah,
as a form of protection for their family, to where
right.
they've they've utilize that policy in such a way to take advantage of the tax buildup inside of it. And they find themselves now in their mid 40s, late 40s, with 100,000 or maybe even more of cash value in that plan. But that policy is not one of these hybrid models, but they could take their policy and perform that code section 1035 exchange and move it to a hybrid life insurance long-term care policy, and either entirely pay for a plan in one fell swoop, or at least significantly offset the additional premium that would be needed for the next 10, 15, or 20 years, so that they do have this covered by the time they hit retirement. What a great way to use some of that earlier planning.
Yeah, and it's sort of a shame because you have these financial influencers or financial personalities, without getting into names, that I think some of their arguments um, run short on buying term life insurance only for protection. And there's nothing wrong with it if that's you don't have the means, yet you have the need to protect your family, because you have a young family and you're the breadwinner, for example. No argument there. But for those people that have the income and the financial wherewithal to buy some of their insurance on a cash value or permanent basis, here's the payoff later on in life if they've done the other stuff, correctly in terms of their planning and saving for retirement, that you can now have this policy and in exchange the old policy for one of these hybrid policies, and the payoff's tremendous. Now to take it, it'd be like, you know, you should only rent your home or rent an apartment for your entire life and never buy and have the equity build up uh, and the benefits from home ownership. I just can't emphasize it enough. There's a great opportunity here for folks.
Well, and I think what you're really getting at, and you're nailing down, is the value and benefit of working with a comprehensive financial planner, and somebody that is going to look comprehensively at solutions as to what problems can this product solve in the future, that may be in addition to the primary purpose of that product, as opposed to working with a narrow focused salesperson whose only job is to sell a single product, who's not looking at your full comprehensive picture all in one view. So Well, with that said, Scott, let's go ahead and wrap this up. How can people get a hold of us if they're interested or have some questions about this?
Yeah, you can start by visiting our website. That's www.latitudefinancialgroup.com. You can email us at info@latitudefinancial.com, or you can find mine and Dan's number on our website.
Great.
Um, and yeah, and hopefully like the video.
Yeah, that's right. If you do find this helpful, we'd love it if you'd hit the like button on the video, subscribe to our channel, and we plan to just continue to roll out new videos on various different topics, questions that we get asked frequently from our clients and prospective clients. So well, I think with that said, Scott, let's go ahead and wrap up for today. I hope that everybody has a great rest of their day, and just thank you again for taking the time to watch the video today, and let us know how we can help you moving forward.